one of two people who look after Temple Bar Investment Trust, and Dan's already described the difference between what you define as value investors, investors looking for undervalued assets within the stock market, and so-called growth investors, investors who look for companies with exciting growth prospects. Now, you can call me biased if you like, but we observe that there is an enormous amount of empirical and academic evidence to show that over long time periods, and that is the key, long time periods. Over long time periods, investors in the stock market have actually earned a premium return from investing in companies which are more lowly valued. And of course, you can define, as Dan has discussed, you can define lowly valued in a number of different ways. You can either compare its market value to the value of its assets, or the market value to the value of its earnings, or the market value to the value of its dividends. But whichever of these valuation metrics you use, you will see that over long time periods, and you can see that this covers a 50-year time period in the US stock market up to 2016, whichever valuation metric you've used, you've obtained a premium return of between 1% and 2% per annum from investing in lowly valued companies. Interestingly, perhaps, if you look at the right-hand side, according to this study and a number of other studies, you've actually earned a suboptimal return for investing in so-called growth companies, companies with rapid rates of revenue and profits growth. And you might be, I wouldn't blame you if you're scratching your head a little bit and thinking, well, surely those companies on the right, the so-called growth companies, the companies with the exciting prospects, surely you would expect them to deliver higher rates of investment return over time. Unfortunately, nothing comes for free in the stock market. And the problem is that if you invest in a company based on a view of its attractive growth rate going forward, the chances are that other investors have spotted this already and have priced the shares accordingly. And what tends to happen actually is that so-called growth companies, the companies with the exciting prospects, become overvalued in the stock market. Whereas the companies on the left, and these are challenged companies, Dan's discussed a few, banks, insurance companies, energy companies, mining companies, tobacco companies. They may be very worthwhile businesses, but they often operate in mature, competitive, difficult industries, perhaps where there's adverse secular change going on and the companies are having to adapt to meet those changes. But of course, don't forget again that they've probably been priced accordingly. And I suppose just to spin it the other way, we would argue that actually it's intuitive that investors would earn a value premium and a premium from investing in lowly valued stocks, because effectively the market is paying them a premium to invest in companies that other investors don't like for the long term. And I suppose, again, back to this concept of the free lunch, why would the stock market reward you with an excess return for investing in better quality, less risky companies? It doesn't feel intuitive to us. And even if it did offer you an excess return for investing in those sorts of businesses, would that excess return not be arbitraged away over time? We think that it would. So actually, we think there's, intuitively and empirically, there are a lot of good reasons to believe, understand why value stocks should provide excess returns over time. This is a silly schematic in a way. It's really just trying to show that value investors exploit extrapolation and overreaction to the company life cycle by stock market investors generally. It's important to remember when you buy a share in a company, you're buying a small share of the cash flows of the business over a 20, 30, or even 40-year time frame. And actually what happens in year 1 and year 2 of that 30 years doesn't make that much difference to the long run or true value of the company to its shareholders. And yet when you get a downturn in the economy, for example, and this is obviously very apt today because I think many investors are quite understandably fearful that many economies are about to go into recession. When you get recession fears, you often see some pretty violent movements in share prices. Number of share prices can halve on the basis of a recession fear, despite the fact that even if you do go into a recession and earnings are impacted or profits are impacted at the company in the first 1, 2, or even 3 years, it doesn't make that much difference to the long-term fundamental value of the business. I suppose what we're trying to say here is that we try and exploit that overreaction by being contrarian, buying for the long term when we think investors are being too short-term in their thinking and selling down fundamentally reasonable businesses to valuations which are too low. I certainly won't go through all of these, but what can create overreaction in the stock market? Well, I've talked about one, the economic cycle, and that's obviously the one that's probably front and center at the current time. There's a thing called the capital cycle. This is this idea that when an industry goes through a difficult time, take energy. Up until the last couple of years or so, oil prices have been relatively low. The industry has been under the spotlight for ESG or climate, as a result of ESG or climate concerns. And as a result, very little capital has been invested in the industry. But of course, we might all want fossil fuel demand to disappear tomorrow, but unfortunately that's not the reality. We are some way from that point. And actually fossil fuel demand has bounced back very rapidly as we've recovered from the COVID pandemic. And when you get a strong recovery in demand coupled with restricted supply, that can set the companies up for very attractive levels of return, and that's what we're seeing today, and we don't believe that that is yet factored in share prices, and I'll come on to talk a bit more about that in a minute. The last one I'd probably highlight here is probably structural declines. This is a very topical area. There's a narrative which has very much taken hold in recent years, and I think that's really comes about because we've seen such enormous amounts of technological change, which is affecting all of our daily lives and obviously is having a profound impact on the way many companies do business in different industries. Retail is probably the perfect example there. There's a massive channel shift going on, as we know, as consumers generally, they shop less in stores and they buy more online. And this creates a real challenge for the retailers because they obviously have to alter their business models to adapt to new consumer habits. But what we don't buy into is this narrative that in 5 years' time, there'll be one retailer, it'll be called Amazon, and every other retailer will have gone to the wall because they won't have remained relevant with their consumers. We simply don't buy that. And we think we can see that there are a good number of companies in the sector that can remain relevant with their consumers, and that those companies, because of the level of mistrust, if you like, in the stock market, are very lowly valued today, and thereby providing an opportunity. It's interesting that Dan mentioned at the beginning, didn't he? He mentioned this idea that value investors look for companies where perhaps you could theoretically break it up, and the sum of the parts is worth considerably more than the value of the company today. And 3 examples jump out from that page: ITV, where it has a studios business which accounts for the entirety of the valuation. The advertising business is effectively in there for free. You might be surprised to know that we think that the clothing business in Marks and Spencer is in the valuation for free. Take Dixon's Carphone. You might not know it's got a Norwegian business, which we think accounts for the entirety of the valuation. So whatever you think of the UK business, and life is going to be difficult for the UK business in the next couple of years, surely, it's in the valuation for free. Thereby, we think providing a great deal of upside as and when some level of confidence returns, and we think it will return at some point. I'm now going to accelerate a bit. We've adopted this approach very consistently. We got over a long period of time, myself and Ian Lance, who manages the trust with me. We have our longest standing client is over 20 years, and during that period, we've managed to double the stock market return, give you an annualized return of around 8% per annum versus around 5% per annum for the UK stock market. But the point we really want to make is that buried within those good long-term returns are quite, periods, and often quite long periods of underperformance. When investors generally are feeling quite risk averse and valuation really doesn't count for so much in the stock market, we would argue that we're in such a period today. So it's really circling back to Dan's point at the beginning. A value strategy can be very, very rewarding over the long run, but you have to be prepared to be contrarian, and you have to be prepared to take a long-term view. When I say a long-term view, I'm talking about a number of years. We think just maybe 5 minutes now on the current market environment. We think that we have been through, and Dan has touched on this also, a very dislocated market. There are some stocks in the markets today, in particular the US market, which have done extremely well in share price terms up until recently, obviously, where the profits of the business have grown nicely, but they haven't grown at the same rate as the share prices. And when profits don't grow as quickly as share prices, it means that the company is effectively the valuation attached to the company is increasing over time. The chart on the left simply shows the NASDAQ, which is the US technology index, and lays it on top of the size of the Federal Reserve balance sheet, which is obviously the central bank in America. No coincidence, perhaps, that as the Federal Reserve has adopted exceptionally easy monetary policies, partially in response to COVID, obviously, those exceptionally easy monetary conditions have created the fuel for what we would define as quite a speculative market, in which some of the more attractive, or the more attractive companies with the attractive growth rates have become extremely highly valued. So the valuation, the chart on the right is a valuation chart. It actually just looks at the software stocks in the UK, so a company in the US, sorry, a company like Microsoft, for example. And it says that the chart asks the question, what valuation is attached to each dollar of sales generated or revenues generated by these companies? It got up to 18 times at the beginning of this year. So every dollar of sales or revenues generated by a US software technology company was valued at $18 by the stock market. That's almost twice the valuation of 10 times recorded at the peak of the TMT bubble, which you might remember in 99, 2000. So what we are saying essentially is these are great companies. Don't get us wrong. Microsoft is a wonderful business. We just think it's way more than reflected in the share price. And we think that creates danger for investors in those companies. It might be that inflation is bringing these hyper valuations to an end. We will see. We don't make forecasts about inflation, but as Dan has made this point already, which is that as interest rates rise, you would expect those companies whose profits are most weighted to the future to be disproportionately impacted, and we have seen some evidence of that in the last couple of months. In contrast, the UK market, again, Dan has touched on this as well, the UK market, especially certainly in relative terms, and we would argue in absolute terms as well, is looking very attractively priced. This chart here and I would ask you to concentrate on the yellow line, looks at a combination of valuation measures, so price to earnings, price to book value or price to assets, and price to dividend, and compares the valuation of the UK market to world markets generally. And you can see that today, this is worth bearing in mind, obviously this is almost a 50-year chart now. According to this measure, the UK market has never been more attractively priced compared to the global indices more generally. Why is that? Probably two reasons. One, obviously Brexit has created a great deal of uncertainty. And secondly, as Dan said, the UK market is made up of some quite capital intensive industries, old economy companies, which are classified as value stocks. And as value stocks have suffered in the last, again, up until recently, in the last few years, the UK market has underperformed. But you have to look at everything from the starting point of today. And we think from the starting point of today, the UK market provides a rare nugget of value in a world where equities generally continue to look expensive. Just looking within the UK market, this is just touching on this idea that we don't think that you should be afraid of cyclicality or dislocation, because it's often what provides the opportunities. Obviously, the economic outlook in the UK, in Europe, in the US has darkened very considerably over the last few months. Inflation was clearly a concern even at the back end of last year. What's happened in Ukraine has obviously added just fuel to the inflationary fire. Central banks clearly have a real challenge on their hands if they're going to get inflation under control without pushing economies into recession. And it may be that that is unavoidable. It may be that we do end up in recession. It may be that we are already in recession. It's very, very difficult to tell. The stock market, of course, is a discounting mechanism. It will move very quickly to try and discount the price of more economically exposed companies, so cyclicals, when it sees signs of trouble. And that is indeed what has happened. So the valuation, this chart measures the relative valuation of more cyclical companies, economically sensitive companies, such as banks, energy companies, versus more defensive companies such as food companies or utilities. And you can see that relative valuation is back down to pretty low levels, and one of the lowest levels we've seen in the last 25 years or so. Worth reflecting that in those previous 5 occasions, so 9/11, Great Financial Crisis, global pandemic, on each occasion we were able to use the dislocation that resulted from the fear of recession to buy into some very attractively priced companies. And we think we're in the process of doing the same thing today. So we think that actually that although cyclicality or uncertainty is disconcerting, investors shouldn't run away from it. They should use it as an opportunity to buy into some deeply undervalued companies. Last couple of minutes from me. If you remember, Dan was talking about earlier about perhaps a yardstick that you could use to define value, a price earnings ratio of below 12 times. Well, look at some of these price earnings ratios. This is the top 10 stocks within the Temple Bar Investment Trust at the current time. Now, it goes, we live in an uncertain world. We don't know, we don't know, the management teams themselves don't know what the earnings of a number of these companies is going to be in 2022. So those price earnings ratios could be some way out. But notwithstanding that, some of the valuations are extremely striking. So on average, the portfolio is on a price earnings ratio of around 9 times. We tend to like companies, if you'll have noticed from the previous slide, that 3 of the top 4 companies are energy companies. We are particularly positive on the outlook for the energy sector, and you can see the price earnings ratios there. Because of this period of underinvestment they've been through, you can see commodity producers is the yellow line, have cut investment by more than 50% over the last few years, at a time when fossil fuel demand remains as strong as ever. And we think that set them up for the juncture, for the situation that we see today, where companies like BP, and this slide relates to BP, it's a busy slide, I'm certainly not going to go through all of it, but all I do is point you to the chart on the bottom right here, which shows the free cash flow sensitivity, the amount of free cash flow that accrues to shareholders at different oil prices. The oil companies themselves use $60 a barrel as for planning purposes. At $60 a barrel, BP is on less than 10 times earnings. The oil price today, as you probably know, is over $100 a barrel. Now, we don't know where oil prices are going to be in six months' time, of course. But what we would say to you is that if you can buy a company on 10 times earnings at an oil price which is 40% lower than it is today, and where if the current level of energy prices were to persist, the companies would be on free cash flow yields, so cash flow yields to shareholders of between 15 and 20%. We think that is an extremely attractive risk reward proposition. So very quickly, just in summary, we recognize that investors are driven by their emotions. Human beings are emotional creatures. At the end of the day, they extrapolate and overreact to existing trends. And we believe that as long as human beings continue to be emotional, then there will be an excess return that can be earned by value investors. We would encourage you not to forget that companies with exciting prospects often become overvalued. If you can see its exciting prospects, then so can everybody else. And you've got to ask yourself, who's selling that stock to you when you go and buy it? Those companies seen as dull or challenged often become undervalued. Value stocks generally have a long history of outperforming as this relative undervaluation is corrected, but you do get prolonged periods of underperformance. You can get prolonged periods of underperformance, and you need to be prepared to tolerate that. We would therefore say that a contrarian mindset and a long-term view are essential. And we would highlight the fact that the recessionary fears of today have driven some cyclical, some more economically sensitive companies down to extremely depressed levels, from which they are priced, we think, to deliver exceptionally attractive returns as and when the storm clouds clear somewhat. Many thanks, and I'll leave it there for now.